For Yigang just before that, and it's a tale of two central banks grappling with very different issues, and of course this also dovetails into the Federal Reserve, which is dealing with problems that that the EU faces, or should I say the euro area faces, but in a different way to here as well. So what do you make of what's happening in a global macro sense?
Yeah. So I think it's really nice to hear a little bit of a different and a more dovish narrative coming out of the Fed, because monetary policy does operate with very large and variable lags on the economy. So, taking a pause and, really seeing how the impact actually is on the real economy is actually really important. And I think markets and investors have welcomed that change in narrative to a large extent as well. So, yeah, that's really it in terms of the most recent developments and the more dovish pivot in terms of the narrative.
Yeah, I mean, is it, though, really more dovish? Because it could end up with rates peaking at a higher level. But, Clara, I want to get a sense of what we have later today, and that is, of course, the all-important non-farm jobs report out of the U.S. Now, if we get a strong reading here, does this perhaps, in a way, encourage the Federal Reserve to be even more, a little bit hawkish, given that it would not be showing that their moves so far in trying to curb inflation has resulted in weaker jobs as it's meant to?
Yeah, I think that's exactly right. When I say a little bit more dovish, I didn't mean rate cuts. I think that's very different than slowing down the pace of rate hikes. So I think from our perspective, we completely expect the Federal Reserve to get to a peak policy rate of between 5 to 5.25% by the middle of next year. Now, when they do get there, what I think is going to happen is they're going to take a pause and really assess what the extent of the damage to the real economy actually is. And then depending on what the damage actually is, then perhaps there could be maybe a signaling or a slight discussion on whether or not to cut rates. But, at this point, it's really too early to be talking about that, because we're still dealing with an 8% inflation problem. And if we do get, good numbers good job numbers tomorrow, I think that's going to reinforce the fact that, the growth and employment environment is still too uncomfortable for the Fed to be cutting rates at this point.
How should you be positioning for the current environment? We had the likes of the BSP governor saying that, that could be a pause for the BSP come fourth quarter of next year. Yeah,
so we actually do like Asia ex-Japan equities, and obviously a lot of that is contingent upon our view that the macroeconomic outlook for China will continue to brighten, and that this recovery that we're seeing in China does have some legs. So, what we've been advocating for our clients to do is really, there's going to be uncertainty, but take a more measured defensive approach at the moment, at least for the next 6 months. And then into the second half of next year, I do think that there will be compelling opportunities that come up in the equity space, whether it's Asia ex-Japan equities fueled by a Chinese rebound, whether it's, in global equities that's focused on, more growth-related stocks that has taken a huge hit due to the increase in discount rate. But really focus on quality companies with good earnings visibility and pricing power is the way to go for it.
So, Clara, we've seen peak dollar, you think?
Yeah, it's difficult to say. I think we are probably past peak dollar, and a couple of reasons for that. I think we're starting to see a little bit more of a dovish narrative coming out of the Fed, and if they were to slow down the pace of rate hikes, and should they look to cut rates, in 2023 at the end of the year, I think that will help to put a cap on the dollar strength that we saw over the last year or so. And also, as global growth improves into the second half of next year, I think that will also help, the risk-off narrative that has helped the dollar to be so strong this year kind of ease off a little bit.
All right. Clara, with that in mind, so it has seen improvement in the second half of next year, but what about the first half? Is that when the chickens come home to roost and we get the fulmination of the central bank policies globally?
Yeah, so I think the first half is going to be extremely important because, we had one good inflation print. That was the October inflation print. I highly suspect that the Fed, along with us, we want to see a few more of those good inflation prints before having the confidence to actually, really, change our views, or the Fed to really deliver a more durable pivot in terms of monetary policy. So I think the first half will be extremely data dependent. Definitely on the inflation front, we're watching that very closely, but also on things like, the labor market. Is it still going to stay as strong? Are we starting to see some cracks that will help to grow into the narrative of the story that the economy overall is weakening and that monetary policy tightening over the past year or so is really helping?
Clara, before we go for 2023, your top conviction, what are your calls?
Yeah, so I think it's a tale of two halves for us. In the first half of the year, we're still really advocating for clients to stay defensive and stay invested through an income approach. We do like fixed income. We think the valuation reset has been too big, and there's a lot of value in the fixed income space, be it in terms of government bonds or high-quality fixed investment grade in the U.S. And then beyond that, we think in the second half, you can start to pivot back to equities once growth really bottoms. And, if inflation also shows signs of further moderation back to the Fed's target of 2%, then I think equities will start to look more compelling then.